Well, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. We made it through 8 weeks of double duty, an intensive course, if you will. We covered a lot of content over the past 8 weeks. We managed to get through the accounting cycle. We talked about a lot of aspects of the basics of accounting. And that's what we've been talking about for the past 8 weeks. And I'm happy to report that the course as a whole, everyone in the course is currently passing. Um, and that is awesome news to me. It means I'm doing what I'm supposed to be doing, which is teaching y'all how to do this stuff. And I'm also happy to report that you know the progress that we've made especially in this course, has been substantial. You all went through a course that I redesigned from scratch, and this course is about to receive a Quality Matters certification as being a very well developed course. And what that does is it gives the course national recognition. In learning science, what that means is that this course has been developed with a lens that is both critical and it has the right amount of rigor for this type of course. And so I wanted to thank all of you for going through this with me over the past 8 weeks. It's been a great ride. And hopefully you've enjoyed it and you've learned a couple of things from me. And I also wanted to say that if you're coming along with me for the rest of the ride to Principles of Accounting 2, starting next week, I'm really looking forward to seeing you there. And if you're not, hopefully I'll see you in the spring. But thank you all so much. I really do appreciate it. It's been wonderful. Okay, let's talk about investing. Investments, you wouldn't think that it's related to accounting because it's more finance, but we account for investments, which is why this is an important chapter. So last week we talked briefly about sometimes that a company might purchase stock in another company, primarily one of their competitors. And the reason why they might do that is because they are looking to possibly take that company over. And the example that we talked about was Starbucks acquiring Pete's Coffee Shop. They also acquired Seattle's Best. And the way that Starbucks did that was they made investments into those two companies, their competitors. And so, how did they do that? They bought a lot of their stock. And so ultimately that led to what we call a controlling influence. So we're going to talk more about that today. We'll also talk about debt securities and equities, which is how the majority of businesses are funded. So, the first thing that we'll talk about is why we do investing. We'll talk about the difference between short-term and long-term investing and what it means for the business. So first, the reason why companies invest into other companies or into themselves is really to gain market share and to ultimately grow the business, right? That's why we would invest anything. So a lot of times companies will invest their extra cash into other companies in order to generate additional income. And that additional income is generated through the interest that's earned on their investments. The second reason is because some companies are set up to earn additional income from their investments. An example of this would be like a hedge fund or a brokerage like like Fidelity or TIAA or name it, right? What those companies are set up to do is to generate income from investing. They're investing companies. That's what they do. And thirdly, another motivation is companies make investments for strategic reasons. And this goes back to the example of Starbucks investing into Pete's Coffee Shop. And the reason for those types of investments is strategic. The company is looking to take over Pete's, and that's why they did that. And we see this a lot with other competitors. For example, one of the most recent ones that you may recall reading about in the news is Microsoft, their game division, Xbox. They invested quite a bit into Activision Blizzard, which is a video game developer, a very large outfit. And so this was one the largest investment in U.S. history of one game developing company investing into another. And that was a strategic takeover of Activision Blizzard that Microsoft did or is trying to do. There's currently some issues with legalities, a monopolistic type of thing going on, but that's the most recent one. Other ones would include like Coca-Cola investing in Pepsi. People might think, oh, that sounds, is that even legal? Sure, of course it is. It's a strategic investment. Oftentimes, what you'll see is these big conglomerates investing into smaller companies. For example, Alphabet, which is the parent company of Google, they are heavily invested in a lot of other tech startups through short-term investing. They do have some long-term investments out there, but there's not as many as their short terms are. With Coca-Cola, they're doing more of a long-term play by diversifying their portfolio. What I mean by that is Coca-Cola invested in a lot of other smaller beverage companies. An example of that is Keurig. For those of you who know, Coca-Cola recently purchased Keurig. They invested a lot of stock in them. They have also acquired Dr. Pepper and a few other cola companies. And so they're more long-term focused with that. And of course, the biggest difference between short-term and long-term is the amount of time that we hold on to these investments. Short-term, we're usually looking at 3 to 12 months. Remember, in accounting, anything less than 1 year is considered short-term. Long-term is anything greater than 1 year. That's the primary difference you need to know. And so in looking at these short-term investments, less than 1 year, they are quickly able to be converted into cash, meaning that the company can sell that short-term investment, quickly convert it to cash. And the investments are usually held 3 to 12 months, as I had mentioned. So that's a short-term investment. Really, these are the three primary components that make up a short-term investment, especially that one where it says quickly convert it into cash. The reason why that is able to quickly sell the stock in that other company that they're invested in. Long-term investing, it's not that easy to quickly convert it back into cash. When you hold on to stocks for greater than 1 year, oftentimes, well, of course, we consider that to be a long-term investment, but it's also difficult to sell that amount of stock in a quick manner. And so that's why it's not as easy to convert long-term stock investments into cash. The same can be said with bonds. And we talked about bonds earlier as well. Short-term bonds, less than 1 year, long-term bonds greater than 1 year. Not easily convertible to cash. The biggest difference, one of the other biggest differences between short-term and long-term investments is with long-term investments, they're reported in the non-current section of the balance sheet. So on your balance sheet, as you recall, we have assets, liabilities, and equity. And then within assets and liabilities, we have short-term and long-term. Long-term assets are also called non-current assets or fixed assets. Okay. So non-current or long-term, you'll see that long-term investments will be reported there on the balance sheet. Other forms of investments include debt securities and equity securities. I'll break these down for you in a very logical way. Every business has either equity financing or debt financing or both. It's usually both. Okay. What I mean by that is when you start a business, you start with equity investment from the partners or the individuals starting the business, the owners. Yeah. The owner brings in cash and some equipment and some inventory or whatever. It's equity. That's a form of an equity investment. Okay. And usually there's some debt involved to help to finance the business. And so the owners of the company also borrow from the banks. Okay? So every company has equity, and most companies also have some form of debt. And both of these things together, when they equal 100%, which they always do, represents the financial makeup of the business. Okay. When it comes to securities, a security is a form of an investment. Some businesses might lend the money to others in the form of a loan, also known as a note, or a bond, or the business might also decide to purchase a CD or a certificate of deposit that you would find at the bank. These are all forms of debt investments. And these can be issued by governments, companies, or individuals. Equity investments, this is where the owners are investing equity into the businesses, their competitors, or even their own business, and it's usually in the form of shares of stock. Sometimes bonds, but mostly stock. So that's debt and equity investing. When you hear the word security, it means investment. So regardless of whether it's a debt or equity investment, we hold on to that security for a certain amount of time. It could be short term, it could be long term. And it might be a small amount or a larger amount. And I want to break down a little bit further the difference between the debt and equity investments as we're thinking about this. When it comes to debt investing, meaning issuing a loan or a bond or purchasing a certificate of deposit, we hold that for a certain amount of time. It's called holding it to maturity. I'm sure you remember that when we talked about bonds, right? It's where you hold on to that bond or that debt investment until reaches its maturity date, that's when you receive the face value plus the interest, right? So with debt investments, we usually hold those to security, to maturity. We could also sell those bonds or CDs or uh, other debts like notes. We can sell them. Yeah. Or we can trade with them, on the security exchanges. So that's debt investing. On the equity side, that's when the company is purchasing stock in another company. Okay. The amount of stock leads to what we call influence. Three types of influence when it comes to the amount of stock that you hold. If you hold a small amount of stock, a couple shares here and there, we call that insignificant influence. Yeah, you got a couple shares. That doesn't mean you can tell the business what to do. Okay, just because you're a shareholder, oftentimes you got voting rights. That's cool, but you can't exactly, dictate what the company does. It's insignificant. And then once you purchase more than 20% of the company, now we're talking significant influence. Okay, own 20% of the company, you're able to have influence over the board of directors. Okay, you can kind of, say, hey, listen, I own 20% of this company. Oh, can do what you will, but now you have to answer to me, the shareholder, and I got 20% of the company shares. I have significant influence. That's what that means. And then we have controlling influence. Okay, here's how this works. In the Starbucks example, when they were acquiring Peet's and Sales Best, they start off by purchasing a couple shares of the companies. Call it insignificant influence. It's a little bit, it's not a big deal. Then they started purchasing more shares and more shares. They got up to significant influence. They hit that 20% threshold. And, now they're able to have assign somebody to the board of directors and, really start to influence those companies in the way that they operate. So more time passed, and Starbucks kept making those investments into Peet's and Sales Best. Eventually, they got to a point where they had controlling influence. At that point, Starbucks owned more than 50% of the shares in both Peet's Coffee Shop and Sales Best. Once you own more than 50% of a company, you are the majority shareholder. Okay. You own the company. You got 51%, it's your company. Okay. So that's ultimately what happened. Starbucks followed that path. Just like we talked about earlier, we've seen this happen in recent history as well with Microsoft purchasing Activision Blizzard. It worked the same way. We see this very common with conglomerates. Coca-Cola did the same thing with Keurig and with Dr. Pepper. Okay, Coca-Cola bought some shares of those two companies, kept going until ultimately they had the controlling influence. Yeah. And so what happens with controlling influence is the reporting is a little different. Once you own the company, which is ultimately what happened here, the company's assets go to the parent company. Okay. What I mean by that is you have Starbucks, which is the parent company. Subsidiary companies include Pete's and Ciel's Best. Pete Ciel's Best, they still have their own set of books, their income statement, balance sheet statement, cash flows, etc. But they trickle up to the parent company report. The parent company at that point is responsible for those companies because they own it now. That's where controlling influence makes a big difference. I'll walk through a couple of examples of these, but I just want to have you understand the difference between insignificant, significant, and controlling influence. So, a couple of examples. We'll start with debt, and then we'll move into equity. Here we have an example. A company is looking to purchase a couple of bonds from another company. So here we have Link Company purchasing, purchasing $30,000 of Dell bonds, buying bonds from Dell. And so here we have 7%. It's a 2-year bond, 30% par value. I can already tell you that this is long-term because it's 2 years. If it was less than a year, it would be short-term. The bond pays interest semi-annual on December 31 and June 30. So here we have the transaction, the first transaction. So July 1, the company purchased bond. So we debit debt investments. This is an asset account on the balance sheet under non-current assets. Debt investments $30,000, credit cash $30,000 to represent the purchase of the bond. And as we mentioned, there's twice per year the company receives interest. So how do we calculate the interest? And you all remember this formula, I hope, I'm sure you do. It's the face value times the interest rate times time. And so face value 30,000 times the interest rate of 7% times time 6/12. Why 6/12? Because the interest gets paid twice per year. Multiply that together, we get $1,050 interest. So we debit cash, $1,050. That's $1,050 companies receiving from the interest off the bond. We credit interest revenue, $1,050. Of course, interest revenue is an income account. It's revenue. Yeah. Then cash, right? So, asset. At the end of the bond, bond's term, we call it being held to maturity. And of course, the face value gets repaid to the bondholder. Debit cash, credit, debt investments to represent the end of the bond. What about trading? So I had mentioned that debts held by other companies can be sold. Absolutely. It's kind of like you have a student loan out. So let's say you have a student loan. Hopefully you don't, but if you do, it is what it is. It might get bought and sold. Okay. For example, you have a lender that your student loan is with right now. That might change to a different lender. You wonder why did that happen? Because your former lender sold your debt to another bank. Very common. This also happens a lot with mortgages, car loans, student loans, other things, right? The banks buy and sell. A lot of it is because they want to make some interest. They want to make some money from it. That's what banks do. Banks are in the business of buying and selling debt and equity. That is their business. Okay, so debt investments, when we trade them, we're actively buying and selling debt. It's managed for a profit. That the idea is that we're going to gain some interest and some additional revenue. Debt investment, debt investing is always current. The reason for that is because the cash flows coming into the business from the debt investment, cash is a current asset. Yeah. The portfolio is always reported at its fair value, whatever the debt is valued at. The unrealized gain or loss is also reported on the income statement, just like a bond would be. So here we have an example. The company trading securities at a total cost of $11,500. The fair value is $13,000. Okay, so that's obviously a difference of $1,500. This difference between the cost and fair value is called unrealized gain, because the value is higher than the cost. When the value is higher than the cost, it's a gain. The opposite would be, of course, a loss. Okay. Now, here we have an example. The security cost is $100. We sold it for $120. It's a $20 gain on the investment. The cash, credit, investments trading, credit gain on the sale of the investment. When a debt is held to maturity, like bond is, and we talked about this in the past, we look at the amortization cost effectively. So oftentimes the business will hold the debt to security. The security to maturity. The debt security to maturity. The company holds on to that because at the end of the bond or the security, we get the face value back, and we receive the interest payments on a semi-annual basis, oftentimes. And then, of course, as I had mentioned earlier, banks that hold the debts or companies that hold the debts, they buy and sell them. Okay, they'll sell them to another bank, available for sale. They're purposely holding on to it in order to earn a gain from selling it at a fair value. Here we have an example. Mitsubishi Company hadn't done any prior investing. In the current period, Mitsubishi acquired 2 available for sale securities. Here we have the information. Mitsubishi purchased Apple, some stock in Apple, or bonds in Apple, for $30,000. The fair value is $29,050. I can already hear you, Dr. B. Why would they buy something more than its fair value? That's a great question. The thing with values is that they go up and down with the market. So the market goes down, you purchased it at a higher price, that's a loss. It happens, unfortunately. And the other investment they made is into Intex, which is, I think that's a rubber company. They do a lot of different things, air mattresses and a bunch of other rubber products. So that there they have a note. which, as you know, is different than a bond. A bond is usually companies receiving equal payments of interest, and it's for a specified amount of time. Sometimes notes, the interest is a little bit more serialized, receive it on a regular basis. So here we have Intex note purchased for $3,000. The fair value of this note was $45,500. So we got a gain here. So when there's multiple investments, we always add them up to find the total cost, total fair value, and in order to find the difference, whether it's a gain or a loss. In this case, we have a $1,550 gain. So we debit fair value adjustment, $1,550, and we credit unrealized gain, $1,550. So with the word adjustment, of course, we made the adjusting entry. When we make that adjusting entry, what we're doing is ultimately we're adjusting the value on the balance sheet for that investment. Here's another example. The same example, just continued. So Mitsubishi has a long-term available for sale security of $81,000 cost. It has an $82,000 fair value. Because of the fair value adjustment, we adjust it down by $550. Right? Why $550? Because of the change in the value from $1,550 down to $1,000. The difference is $550. Okay, so that's debt. We'll talk about the equity side. This is the part I like a little bit more. That's interesting, but equity's better. Equity's more interesting to me anyway. So influence, as I mentioned earlier with the Starbucks example, Starbucks purchased Pete's Coffee Shop and Seattle's Best. The way they did that was by purchasing stock in both of those companies. And so they started off by making small investments in those companies. At that time, it was under 20%. So we call that insignificant influence. They have voting shares, but they really don't have a whole lot to say about how the company's being run. Then they start to make additional investments, and we move into more significant influence. Now, at this point, the company can say, hey, we should have somebody on the board of directors to represent us. They can start to have some sway on the way that the businesses are run. And then, of course, they kept investing, and now we're over 50%, which means we're a majority shareholder, which also means that we have controlling influence over the business. Here's how this works. When it's insignificant, we just report it at its fair value, whatever the stock investment is at its fair value. So we would debit stock investment, credit cash, based off of the number of shares times the purchase price. Yeah, very straightforward and significant influence. With significant influence, now we have a little bit of equity involved here. What I mean by that is, in addition to the reporting of the stock purchases, we also are able to collect dividends from that company because of the significant influence. But when we moved into greater than 50%, we own the company at that point. So we use what's called the consolidation method. When Starbucks reached that 50% threshold with Pete's and Seattle's Best, the way that worked is basically an acquisition because the balance sheets from those two companies flowed up in Starbucks, you see, through what we call consolidation, combining, consolidating. So I'll show you what all that looks like. So let's do insignificant first. Again, very straightforward. Insignificant influence. We purchased 100 shares of a company valued at 7,000 total. Debt, stock investments, credit cash. Over time, we might receive some dividends from that investment. So in this case, we received a little bit of a dividend. That's nice, $10. Oh, it's how fancy. Debit, cash, credit, dividend, revenue when that happens. So with a significant influence, we record everything at its fair value. So we have that $7,000 investment that we made. We earned a whole $10 from the dividend. What happens when the value of the stock that you have goes up? We have to report that gain. Right? Now, let's say we bought it at 7,000. The value of the stock went up to 9,000. That's an unrealized gain of $2,000. We purchased it at 7, the value went up to 9. Okay, so at the end of the year, we make an adjusting entry to realize that gain. So we debit fair value adjustment to the stock, increase the value of the stock on our balance sheet, and we credit unrealized gain income, which goes on the income statement. And of course, the opposite's true if the value went down. Let's say it went down by 2,000 instead of up. Well, there'll be an unrealized loss. So that's what happened in that. What would happen in that case? But in staying with our example and looking at the assets on the balance sheet, we adjust upward because there's an unrealized gain, which brings the total stock investments up to 9,000 based at its fair value. What happens when the company wants to sell some of that stock? Yeah, it's pretty straightforward. So the way it works is we would just debit cash, credit the stock investment for the amount of the stock that we're selling, and of course, if there's hopefully a gain on the sale of that investment. Yeah, very straightforward. Now, moving into the more significant influence of stock ownership. So, with this, it's a little bit more complex because as the company gains influence, there's some equity involved here. And with that equity, it needs to be reported on the balance sheet. So, we'll talk about that here in a second with some examples. So, another very well known company, Micron, they mainly focus in semiconductors and small electronic components. Micron recorded a purchase of 3,000 shares of stock, which represented 30% of the company in Star Company, which is common stock for a total cost of $70,000 in cash. 30%, that's a decent amount of shares. So the way we record that original purchase of stock is we debit equity method investments and we credit cash. Here's where the equity part comes into play. Because Micron owns 30% of the shares of Star, the company Micron is entitled to a portion of the retained earnings of Star. Retained earnings, of course, being a form of equity. So here's how that works through this example. So on December 31, Star, that's the company that we bought shares in, reported a net income of $20,000. Because Micron owns 30% of the company, we record the earning like this. We take the 20,000 net income times 30%, which in this case is 6,000. So that technically means that Micron would receive a portion of that through dividends because of the percentage of ownership. So Micron would debit equity method investments by 6,000 and credit earnings from equity investments. Sorry. And of course, Micron would receive from Star those dividend payments for time. And so here we have an example of that. Star paid $10,000 in a cash dividend to Micron. Oh, I'm sorry, to their investors. Based off of the equity investment, of course, it decreased by 10,000. We take the 10,000 times the 30% ownership, which is 3,000, is what Micron would actually receive in this dividend payment. So we would debit cash 3,000, credit equity investment 3,000. With significant influence, based off of what we just saw in those examples, when there's significant influence involved, what that essentially means is any type of net income that's generated or dividends that are paid out based off of the percentage of ownership in the company would receive that percentage. That's what equity investing is all about. Okay. Of course, as the share price changes, so does the book value. It's a cost plus or minus the dividends paid out and the earnings per share. When the company decides to sell the investment, this is the type of recording we would have here. So we sold the Star stock for $80,000. The equity investment on our books is $73,000. That gives us a $7,000 gain. Now, for the fun one, the controlling influence. With controlling influence, a company owns more than 50% of the company that they've purchased the stock. And so with that, we use what's called the consolidation method for reporting. And ultimately what that means is that their balance sheet flows up to the parent company. The earlier example I used was Starbucks that acquired Peet's Coffee Shop and Seattle's Best. Peet's Coffee Shop and Seattle's Best rolled up their balance sheets up to Starbucks, which Starbucks at that time became what's called the parent company. Seattle's Best and Peet's Coffee Shop are subsidiaries of Starbucks. So it gets very complicated. So we're not going to dive terribly deep into this part of the major when it comes to controlling influence. I just wanted you to kind of understand, how those types of investments work, because you might see that at some point. And In accounting, that type of accounting can get very complicated when we're talking about conglomerates that have the parent company that has a lot of subsidiaries. So I just wanted to show you at a very basic level of what that looked like. That was why we went through that exercise. This kind of summarizes short-term and long-term securities investments, whether it's held to maturity or traded or available for sale, and depending on the levels of influence, what happens when it comes to how it's being recorded, whether it's at cost, at fair value, or if it's the equity method. You might see at the bottom of an income statement, you might see this line item called comprehensive income. Comprehensive income represents all the changes in equity that have occurred during the accounting period, except for owners' investments and dividends. The way I like to think about comprehensive income is it's all the other income the company generated. That's why we call it comprehensive. It usually involves a lot of things. Okay. It usually has things like changes in the value of available for sale investments, changes in foreign currency, especially if it's a multinational company, or changes in hedging, etc. It gets very, very complicated. But I just wanted you to understand what comprehensive income is and why you might see something like that on an income statement. You usually only see these types of line items when a company does a lot of investing in other companies, or if that company is multinational, meaning that they have operations in other countries. And of course, we got to talk about a couple of ratios, and one of my favorite ones is the return of total assets. The return of total assets, also known as return on assets, represents the overall financial performance of the company. It basically measures how well the company is utilizing their assets in order to generate revenue or sales. That's why I like it. Okay. So return on total assets, here's how it works. We take net income divided by average total assets. How do we get there? We take the profit margin times total asset turnover. Those are two other ratios. So this ratio is a little complicated because it actually involves two other ratios. So we do them one at a time. Profit margin. How do we find profit margin? You take net income divided by sales. What about total asset turnover? We take net sales divided by average total assets. Remember, average total assets is beginning balance plus the ending balance divided by 2. That's how you find the average. So to sum it all up, because of the whatever equation that is, the one where things cancel out, the numerator and denominator, I'm sure there's a term for that. You know how it is. When you multiply two fractions, when you have common numerator, common denominator, they cancel. Yeah. So that's why net sales disappears. The easy way to remember return on total assets is take net income divided by average total assets. Okay, so yeah, the return on total assets, higher the better. Yeah, simple. Okay, that's the end of our discussion on investing. Any questions about investing? Anything? Questions on investing? Come on, don't tell me I did that good of a job. Yes, no, maybe. Any questions? Investing. Going once, going twice. You all good? Okay.
We're fine, Professor.
Okay, just making sure. Just making sure. Sometimes it gets complicated. That's why, I try to take my time with it, these more complicated topics. So, okay, let me stop here. We'll switch gears. We'll talk about the fourth and final, most important, in my opinion, financial statement that a company can use to their advantage, and it's called a statement of cash flows. So let me just switch gears here, so please stand by.